Welcome back, traders and investors. We have Andrew Giovinazzi on the line with us, back again, COO of Options Pit. And he's interested in talking about investing in a low VIX environment. But is the VIX, is it spiking a little bit now? The S&Ps have just had a big sell-off.
Yeah, it's moving. As far as this morning goes, it looks like it. You had kind of, I guess, a hot CPI number.
Correct.
So we get maybe a little bit inflation this morning. Building confidence looking a little better. So instead of being maybe down 0.5%, only down 0.25%. But as far as like vol futures go, it's kind of a muted reaction. So as far as low vol, we really look at the volatility futures to give us a guide. And right now they're pretty pre-market. So there is a let's just call it a muted response from volatility, at least pre-market.
When you're looking at these of the volatility futures, obviously there are at basically the lowest level that we've been in a long time. Do you think this volatility is going to start to come back into the market, or is this just a trend that's going to continue and the volatility is going to continue to go down? And is it more just because obviously the Fed's behind this market, or is this a market structural thing? Why do you think the volatility continues to remain so low?
Well, I think they just keep taking pieces out of the market that are potential big moves. So, all of 2013, every time the Fed did something, remember, we could have like a 1% to 2% move, right? Even sometimes on the upside in 2-day moves. So while you had sort of that nagging crisis mentality on the downside, on the upside, you also had potential movement. So that kind of movement generally pulls at the money volatility up. Ever since the Fed started coming out, if you look at the chart of the VIX from the beginning of the year, that activity has really pulled back. Like those big jumps we've had, maybe except coming off of the emerging market stuff. But, the Fed has basically taken itself out of a lot of the movement this year so far, and that's helped drive down the VIX, just because if the Fed gets out, everybody thinks there's slightly more certainty, and if there's slightly more certainty, volatility historically has always gone down. But we're getting to about the bottom. It's hard for it to go really below 10 for the VIX for any sustained period of time. So, I mean, we only have so far to go, and then we really can't go much farther down. So that's where we are. And for now, the vol futures have stayed at a pretty good premium to that, generally having a hard time dropping below 12 to 12.5 on any short-term basis. So the volatility at least is somewhat in the futures, not so much in the underlying VIX cash itself. So we could still see lower levels after this Fed announcement this week. If they stay the course, you'll probably see volatility in vol futures drop a little more. If they surprise everybody, we could see a short-term pop in vol. So as usual, you watch the volatility as it jingles around here before the Fed speaks, and that's kind of where we're at right now.
The CBO came out with like a shorter term VIX contract. Is that been something that you've been looking at on your radar trading, or are you just sticking with the longer term one?
We look at it. We just haven't seen enough volume in
Right.
it to warrant any activity. I think it would be a good. I think it's a good product if you really expect that short-term burst of upside vol, because it's. I would say it's not trading a lot because that the VXST is just hovering at these low levels and it bounces like a buck, which relative to the premium in it, you're not getting a whole lot of action for the product yet. Once we get VIX back into, let's say, the 20 level where volatility is really ripping around, that product will probably start to generate interest. As of right now, it's not doing enough to really get people excited about it,
Okay, so we're in a low volatility environment here, low VIX. So, there's really not a lot of juice unless you're going out to longer term contracts to be selling options, and there's a lot of risk. On the other hand, if you're buying options and stocks go absolutely nowhere, then you're losing money as well. So what are you looking at in this low VIX environment? Are you looking at option spreads, or are you just going the options, the puts and calls are just so cheap that you can go at the money or just below the money and get a commensurate move with the option as a stock?
Well, it's like anything, it's like a combination of. So, like trades for gold, as we're coming into what the next Fed announcement is, that could be, let's say, kind of, 2 to 3 week straddle type trades where we're looking at, more like an at the money put and an out of the money call, or just out of the money call. So the delta's short, but it has essentially a lot of gamma. So if you do get a move in gold like we're seeing this morning, because the options are so cheap in general, it doesn't take a whole lot of a move for the positions to make money. So we stick kind of with the long gamut and things that we think are still moving relative because the volatility is so cheap. So, and there's just a lot of stocks like that. So for stocks that are looking have more potential movement, let's say, we're looking sort of at buying, closer to the money options. And then against that, we look at selling options more at the money, but in the indexes because they're not moving so much, but keep the risk like a little tighter, butterflies and things like that. So you generate some theta, you generate some time decay from the butterflies and things like that at the money, let's say in the big indexes, but you buy options, cheaper options in some of the names that are still exhibiting a little bit of movement right now. So you got a little short and you got a little long, and hopefully in balance, when everything sort of works out, you have a chance to make a little money trading in this environment. And it keeps you from just being just naked short everything, which at this level is just, the penalty is too much just because the options aren't that expensive.
Do you think with the options so cheap, obviously, with the VIX this low and the options cheaper, that participants, that are trading these options are buying them, and that can actually lead to even lower volatility just because there's so many, is like the open interest higher when the volatility is lower on individual options?
As far as open interest goes, I don't know if I could answer that directly. I've never been much of an open interest follower. What we have been seeing is a lot of buying in the areas that are kind of susceptible to takeovers right now. You've got medical device option buying. You've got buying in like the food products, like the Sanderson Farms and things like that. So you see kind of buying in areas that are potential takeover targets. You're not seeing a whole lot of buying in, let's say, index options, except actually in all the downside puts. There's a simple little index we follow, the SDEX, that just measures the 25% out of the money put to the at the money 30 days out. That index hit, I believe, a near-term high yesterday on all this Iraq stuff. So what people are buying right now is they're starting to load up on a lot of downside puts. Generally, historically, when we've seen that, they're buying those puts because they want to keep their long. So you got positions where you have, let's say, you just want to be long the market. You don't want to sell it. So what they do is they just buy puts from protection and then just let things ride. And you're kind of, I think, at least, if you see if history is any guide like that, that's what we're seeing. So they want to buy that protection to keep their long. And if you look at the SDEX, every time it kind of goes above 66, the market is generally kind of headed for a little bit of a sell-off. So we'll see if that's the case this particular time. The last time was in mid-March, and the time before that was in mid-January. Now, one was the Russian thing, and then the emerging markets in January. So we'll see if, because they're basically buying puts into crisis, and we'll see if whatever this Iraq thing actually pans out. As of right now, it's kind of a muted result, but the put buying is definitely in the out of the money in, let's say, the S&P 500 puts.
Okay, all right. We've had Andrew Giovinazzi on, COO of Option Pit, talking about investing in this low VIX environment, being cautious, but not ready to put on the black swan positions as of yet. So thanks, Andrew, for coming on. We'd hope to have you on the show once again.
Hey, thanks again, guys. Have a good day.